In this presentation, I will show you 7 most important market indicators for monitoring the stock market. These 7 indicators will give you an objective view on the state of the market. And by the way, I review all these indicators in my S&P 500 analysis video. If you are new to this channel, I have placed a link in the description below for one of my S&P 500 analysis videos for you to watch and for you to see how these indicators are put into practice. The things that we need to know when we are monitoring the market are the sentiment, the market internal or the market vital sign, and confirmation. I will go through each one of these categories and show you the indicators that are associated with them. Starting with the VIX, one of the sentiment indicators, sometimes it is also known as the fear index. We use the VIX to gauge the fear level of the market participant. This indicator is based on the volatility of the S&P 500. It measures how fast and how much the price changes. Here are the levels to watch on the VIX. When the VIX is above 20, the market participants are fearful and they are taking risks off. And when the VIX is below 20, the market participants are complacent and they are taking risks on. The other sentiment indicator we use to gauge the market participant sentiment is the put-call ratio. The put-call ratio tells us how bullish or bearish the market participants are. The ratio is calculated by dividing the number of traded put by the number of traded call options. When this ratio is greater than 1, it means there are more put being traded than call. And when the put-call ratio is less than 0.5, market participants are being greedy and they are piling on risks. And when the put-call ratio is greater than 0.75, the market participants are putting on hedges and taking off risks. Here's a chart of the S&P 500 and the VIX and the put-call ratio. Here's the most important market internal indicator, in my opinion, the cumulative advance decline. This indicator represents the running total of the net difference between the daily number of stock advance in price and the number of stock decline in price. The value are plotted as a line chart. That's why sometimes it is called the AD line or the cumulative AD line. There's one set of value for the stock traded in the New York Stock Exchange and another set of value for the stock traded in the NASDAQ. It is used to monitor the strength of the market movement. So when the AD line is moving up, it means a strong move from the market. And when it is moving downward, it means a weak move from the market. And when the AD line is diverging with the index, it tells us to watch for a potential change in market direction. Here's a chart of the cumulative AD line. And here is a plot of the S&P 500 closing price. Here's an example of a negative divergence between the AD line and the S&P 500. As the S&P 500 moves higher and the AD line is moving lower, it warns us to be prepared for a potential downward movement from the index. And here's an example of a positive divergence between the AD line and the index. As the index makes a lower or equal low, and the AD line is making a higher low, it alerts us to expect a potential upside move from the index. Next market internal is the up-down volume ratio. It is a ratio between the up volume and the down volume. When the up volume is greater than the down volume, the up-down volume ratio is positive, and it is calculated by dividing the up volume by the down volume. When the down volume is more than the up volume, we designate it as a negative value, and it is calculated by dividing the down volume by the up volume. This indicator monitors the buying strength and the selling pressure. Positive up-down volume ratio means strong market move. Higher the value, the stronger the move. And negative up-down volume ratio means weak market move. More negative the value, weaker the move. Another market internal is the daily advance and decline. This indicator is the net difference between the daily number of advancing issue minus the daily number of declining issue. It measures the market participation. The larger this value, the more stock are participating in the market move. If the AD or the advanced decline is positive, it is a strong market, and if the value is 1500 or higher, then it is a broad market participation on the upside, meaning more stock or pushing the market up. If the AD is negative, it is a weak market, and if the value is minus 1500 or lower, then there is broad market participation on the downside, meaning more stock or pulling the market down. And here's the up-down volume ratio chart, and here's the daily advance decline. Another market internal is the daily new high, new low. The new high, new low is just the net difference between the daily new 52-week high minus the new 52-week low. This market internal also measures the strength of the market movement. When there are more new high than new low, strong market movement. When there are more new low than new high, weak market movement. Here is the new high, new low chart. The final thing we need to watch is confirmation. The confirmation we are watching is for the index moving up and down together. In a strong market, all indexes move up together and make new high together. In a weak market, only one or two indexes moving higher or making new high. So here's a chart with the major market indexes, and notice the blue arrows, which point to the time when the index made new closing high. And this chart shows the market does not have confirmation on the most recent high that was made by the NASDAQ 100. Those are the 7 things you need to watch in order to gauge the state of the market. To gauge the market participant bias, we monitor the sentiment indicator, the VIX or the fear index to determine the market participants' fear level, and a put-call ratio to gauge the level of bullishness and bearishness. And to monitor the strength of the market, we watch the market internals, the cumulative advanced decline or the AD line for potential change in market direction, up-down volume ratio to gauge the buying strength or the selling pressure, the daily advance and decline to see how broad is the rally or the sell-off, and new high, new low tell us how strong or how weak the market is at pivot high or pivot low, respectively. And finally, confirmation. Are all the indexes moving in unison? I hope you found this presentation to be educational. If you have any question or comment, post them in the comment section below and I will answer them as soon as possible. If you are new to this channel, be sure to go check out one of my S&P 500 analysis video to see how these market indicators are put into practice. I have placed a link in the description below. Subscribe to this channel if you'd like to see more of this type of video. Good luck and stay safe.